Hello everyone, I'm Monica from MBA final year, and in this video I'll be explaining you all a topic from strategic financial management, that is how financial forecasting helps in requirement and utilization of funds. So firstly we need to understand what forecasting is. In a very simple terms, forecasting means to say what will probably happen in the future, but with the help of exact and right information. Also, we can say it is a technique that uses historical data as an input to make informed estimates that are predictive in determining future trends. Now let's relate forecasting to financial forecasting. So financial forecasting is a vital part of business planning that uses past financial performance and current conditions or trends to predict companies' future performance. As I mentioned earlier, that prediction is done only with the help of relevant data. So here the past financial performance is being considered to predict the future one. Now the thing is, what are the benefits of financial forecasting? So it takes control of your cash flow and purposefully direct your company. Then it develop benchmarks for using future forecast. Also perform contingency planning during challenging financial time. Anticipate the impact of new expenses. Identify financial problem areas and their causes, reduce financial risk, and many more. So a company should always go for financial forecasting. It will always help them in a positive manner. Now the thing is, what are the components of financial forecasting means what are the things that a company need while doing financial forecasting. So it is projected income statement, cash budget, projected balance sheet, and projected sources and uses of funds statement. So there are various types of financial forecasting techniques, and they are categorized into two techniques. One is qualitative technique and another one is quantitative techniques. Here are mentioned the techniques under each category. So as we have executive opinion, market research, Delphi method, reference class forecast, and sales force polling in the qualitative technique. And on the other hand, they are causal method, simple linear regression method, multiple regression method, day sales financial forecasting, and time series method in quantitative techniques. So now we will see techniques of financial forecasting in a detailed manner. So we'll discuss few of them. The first one is straight line method. So the straight line method is the one of the simplest and easy to follow forecasting method. It's just that you need historical figures and trends to predict future revenue growth. And the other one is moving averages method. Moving averages is a smoothing technique that looks at an underlying pattern of a set of data to establish an estimate of future values. The most common type are 3-month and 5-month moving averages. Here in this method, moving averages are calculated like for 3 months or 5 months, and then the rest is predicted on the basis of that. Other two techniques are simple linear regression and multiple linear regression. So what happens in simple linear regression is this regression analysis is widely used tool for analyzing the relationship between variables for prediction purpose. So now here what happens, you take one variable and apply it to see what happens to another variable. Simple regression is a linear regression model with a single explanatory variable. Then multiple linear regression, company uses this method to forecast revenues when two or more independent variables are required for a projection. For example, we will run a regression on promotion cost, advertising cost, and revenue to identify relation between these variables. So the main topic is how financial forecasting helps in requirement of funds. So financial forecasting helps in making decisions like capital investment, annual production level, operational efficiency required, requirement of working capital, assessment of cash flow, raising of long-term funds, estimation of funds, a requirement in business, and estimating growth in sales, etc. All these things are the important part of a business which is being done with the help of forecasting. So all these things require funds, so financial forecasting helps in a way that we can allocate how much fund we need in a particular item or in a particular department. So that's how financial forecasting helps in requirement of funds. So this was a brief about financial forecasting and how financial forecasting helps in requirement of funds. So yeah, that's it, and I hope I was able to make it clear. Thank you so much.